Hi, I'm Tekoa De Silva with Sprott Global Resource Investments, and I'm sitting down here again today with Rick Rule, Chairman of Sprott U.S. Holdings. Rick, as always, good to see you.
My pleasure, Tekoa. Thank you.
Yeah, good to have you here. In one or two of our last interview commentaries, we talked about the fear that's in the sector right now, and we also talked about Ebola and Burkina Faso. And the headline that seems to be dominating the space right now, the resource space, is energy. Oil's just collapsed. Does this, I guess, fit the next excuse for the person looking to sell the devastation we see in that sector right now?
I suspect it does. Perhaps not the speculators, because oil and gas is not as speculative as mining, despite the fact that people have been punished fairly severely in the last 60 days. And I don't know that a decline in oil prices would scare too many mining speculators out of the market. Those who are inclined to panic have probably already exited. It's worth noting, Tekoa, that a decline in oil prices, first of all, is temporary. When I say temporary, it might be 2 years, it might be 3 years, but as we've discussed before, markets work. But the other thing that we have to talk about is that the decline in oil prices is good for the mining industry in a couple of very important ways. One of the most important marginal costs in production is energy, and lower energy prices certainly help energy-intensive businesses like mining. The second thing is that lower energy prices act in effect as a tax cut. They increase the average worker's disposable income as a consequence of cutting his or her expenses. It has been estimated in the United States that today's crude prices will save the average motorist $100 a month, which may, I'm not saying it will, but may stimulate the economy, at least in the near term, and increase demands for goods, which would in turn increase demands for commodities, ultimately, ironically, including oil and gas.
About a week or two into that collapse, I would say the second leg of it so far that we've seen in oil, we had some really nice charts here circulated by Jeff Howard showing the collapse in oil from 1985 to 87 and then again from 2007 to 2009. Both of those collapses showed about a 70% sell-off in the price of oil. Is past prologue here, and should we expect a similar type of close to the sell-off in percentage terms?
It could well be. It's really a function of the demand response. People, I think, mischaracterize the nature of this sell-off, and it's important to talk about the sell-off in terms of what you expect with regards to its duration and its extent. A lot of people make a lot of increased American supply, and I think that is mischaracterizing the nature of the sell-off. I think it's demand related. If the nascent recovery that appears to be occurring in the United States, I noticed that the last jobs report actually showed workers' incomes rising. If that continues, then this sell-off in energy could be remarkably short-lived. Notice that I said if. I'm not an economist. The irony, of course, is that in the last 3 or 4 years, the only private sector in the United States that has shown rapidly rising wages and salaries for the average American worker has been the oil and gas sector. And the wage pressure in the oil and gas sector is probably going to come off as a consequence of lower prices. But I digress. The truth is that I have absolutely no idea personally as to either the extent or the duration of this sell-off. I only know that now, as in last sell-offs, that markets work. The cure for high prices, despite Washington's consternation last year over high gasoline prices, is high prices. The best thing they can possibly do is nothing. The cure for low prices simultaneously is low prices. The truth is that low energy prices will constrain supply over time and stimulate demand. Markets work. They're very messy, they're very unpleasant if you get caught on the wrong side of them, but markets work. That's a truism that all of our listeners need to remember.
We've also had a little bit of internal conversation going on about the ramifications to the credit markets of the sell-off in oil. And I think there was a number quoted as something over $1 trillion worth of energy-related debt that's going to now come into question with this lower prices. Can you explain how that phenomenon works?
Sure. The structure, particularly in the exploration and production part of the business, which we're mostly concerned with, involves a lending structure called a production credit facility, an evergreen production credit facility. And the way it works is that a company has its reserves and production evaluated by a third party, and that third party presents the management team with an evaluation and an estimation of the net present value of the cash flows from existing oil and gas reserves. And a lending institution generally establishes a borrowing base at about 50% of the net present value of the company's proved developed producing reserves. And these facilities are usually evergreen, meaning that they're interest only and they roll over from year to year to year, as long as the collateral doesn't exceed some collateral test. Now, the problem with the situation that we've just experienced, particularly the problem with the fact that it occurred at year end, is that the net present value of production that'll occur in the next 2 or 3 years at $100 is much higher than that net present value of that same production at $60. So the borrowing base will be reduced. In some of the credits, what was an evergreen facility, that is interest only, will become a 4 or 5 year term facility, and there will be no room for additional credit. In fact, maybe the requirement to pay down some existing credit, which means in the first instance that the companies will have no expansion capital. Now, if that company has been drilling shale wells with very high initial production, but then rapidly declining production, the fact that you aren't replacing production in new wells means that your production and hence your cash flow falls off very, very, very quickly. So, and this is a situation that if you're as old as I am, you have observed 2 or 3 times before. The problem that some of the smaller over-leveraged producers will have is that they're going to have to sell some properties in competition with other small producers that are similarly over-levered into a market that is cash constrained because there isn't much credit available for acquisitions either. Now, for Sprott, this will be a wonderful set of circumstances. We have 25 years experience in the mezzanine lending business. And in this sort of situation, if you're a Sprott, not if you're a producer, you go to the senior bank and you say, right, term out this loan. We will add the capital to the company to do the development drilling to support your facility. Agree in an intercreditor agreement with us that you won't foreclose for 5 years. In other words, that we aren't contributing money to pay down your debt. And the bank will term out a facility at prime plus 1.5. We'll put in a mezzanine structure behind their 1.5% credit at prime plus 8.5 or prime plus 9.5. The shareholders get a chance to live. The senior bank doesn't have to provision for their loan, and we make an extremely attractive rate of return on low-risk development drilling. So it really depends on who you are as to how you view the upcoming credit contraction in oil and gas. I need to say one more thing. In terms of the solvency of the banking system in general in the United States, this decline in energy prices is a very good thing, because as painful as it may be for the exploration and production business in the United States, it's pretty good for the refining and marketing business. Their crude costs fall, and it's wonderful for energy intensive businesses like chemical producers, like trucking companies, like airline companies. So while on the one hand it weakens the credits behind $1.6 trillion in credit facilities in the United States, it probably strengthens another $6 trillion in corporate loans in the United States. So on balance, declining energy prices are good.
That type of product, Rick, that you just talked about, that mezzanine structure lending product, what type of client would that be ideal for? And can that person reach out to you or us in getting prepared to take advantage? A client that wanted to participate with us in those types of loans would need to be an accredited investor according to the meaning of the Act. And that client would need to get in touch with his or her global broker to have a much more fulsome discussion of the duration and the risk associated with that loan. It's worth noting that Sprott makes a substantial number of energy credits from its own balance sheet. So Sprott shareholders are automatically indirect participants in this business right now. And just for reference for the person watching and also to better understand this business, in that type of lending activity, what's the biggest risk that you face?
The biggest risk is that the manager, me, or the rest of the Sprott team, makes a mistake evaluating the credit. We try and ameliorate that by knowing our borrowers fairly well, and by certainly not putting all our eggs in one basket. But the truth is that this is hybrid debt equity. You're taking a subordinated position to the senior lender, and if you make a mistake, you get hurt. Our track record with regards to not making mistakes over time in the credit business is pretty good, but certainly somebody needs to know that the biggest possible risk is manager mistakes.
Mm-hmm. I'd like to ask you, Rick, now about a process that you've talked a lot about, and you used the analogy of being caught in a big ocean wave, caught underwater, tumbling and rolling, not knowing what is up and not knowing what is down. The process that you described in terms of revaluation of assets and energy, I think it sounds like it's pretty important to that. I had a conversation with one of our geologists in-house, Andy Jackson, the other day, and we talked about reserves and resources on some companies still being valued at higher gold and silver prices. Where are we in that sense in terms of getting the sector written down to today's prices?
We're lagging substantially. And Andy was talking about the minerals business as opposed to the oil and gas business. In the minerals business, there have been a lot of 43101s, which are thumbnail economic evaluations of projects that have been written at much higher commodity prices. The one in question was written, I think, at $1,350 gold and something like $30 silver. Numbers that are substantially higher than the numbers that prevail today. And one of the things that's important for us to do as analysts, but much more important for individual investors to do because they forget to do it, is when they look at the headline number on a 43101 or a preliminary economic assessment or even a feasibility study, they have to look at the assumptions. The idea that you can look at the executive summary, look at the final number and be happy with the process is certainly a mistake. You have some companies that are reporting gold projects at $1,000 gold. You have other companies that are reporting gold projects at $1,350 gold. This is not comparing apples to apples. This is comparing apples to oranges. And the problems don't stop there. You'll have some companies that are talking about mining costs at $4 a ton. Other companies that are talking about mining costs at $1.50 a ton, mining very similar projects. You'll have other companies that are talking about 95% recoveries. This is fiction. And it's important for investors who look at these third-party evaluations or internal evaluations and not just look at the final number. Pay real attention to the assumptions.
Would you say that those types of write-downs and those a resetting of those assumptions are essential for the sector to find a bottom, for the street to understand the reality of the resource market as it stands?
I think that's part of the process. I think what's more important is that individual investors and through them institutional investors have a much more jaundiced view of the industry generally. The fictional nature of some of the economic data is one manifestation of a financial services industry and an investor base that has been too tolerant of management misfeasance and management malfeasance generally. The levels of general and administrative expense in the mining industry, in particular in the junior exploration industry, relative to capital employed, return on capital employed, which every year is negative, and exploration expenditures is deplorable. There's too much G&A. The salaries have been too high. In particular, the salaries have been too high in periods of time like the last 3 years when the industry can't afford them at all. The severance payments associated with change of control have been the main reason why you haven't seen amalgamation in the industry, which the industry needs to survive. So a focus by the investor on the upside and the downside is what will really allow the industry to thrive. The truth is that as an example in the TSXV, there's probably 400 or 500 surplus companies in Canada. As my friend Otto Rock says, please don't feed the animals. Don't give these guys any more money. Make them go to company heaven. Thank and excuse. I mean, think about it. 500 companies at maybe $700,000 a year in general and administrative expense, including listing fees and auditing fees. That's an enormous amount of money, and it is every dime of it, wasted. We need to cut this out of the industry so that there are fewer, better, more solvent players.
Rick, I think you really hit the nail on the head there, and that was my next question for you about compensation, because we did have an Excel sheet that circulated throughout this office recently, and we studied the subject of G&A. And I remember asking you in a meeting, and I want to ask you here again about that subject. At previous market bottoms, in previous cycles, have you ever seen this outsized, if you could call it that, level of compensation being offered to CEOs, directors, multi-million-dollar salaries in some instances, in which share prices are down 70 to 90% over the last 2 or 3 years? What are your thoughts?
I've never seen compensation as a percentage of assets or total expenditures that come close to this. This industry was really truly obnoxiously overcapitalized in the period 2004 to 2011. And most of the capital went to capital heaven. A substantial amount of it as a function of G&A. We've done some work internally here, and hopefully we can recruit some very smart intern to finish it off, that talks about compensation as a percentage of book assets, and compensation as a percentage of expenditures on the TSXV. The preliminary work that we did showed that more than half of total expenditures by TSXV companies in the sub $50 million market cap range, represented by a statistical sample of 75, went to G&A. We need to true up that study over 5 years and expand the scope of the study to determine whether that's true. The other scary thing that we've seen, and the other scary piece of research that we'd like to finish off at Global, is the severance liabilities that these companies have in the event of amalgamation or change of control. A company was pointed out to us by a customer that had an $8 million market cap and $7.8 million in change of control obligations. It's pretty obvious that no merger would take place, because if a merger took place, there would be, what, $200,000 or $300,000 available to the shareholders? The managers would get all of the rest of it. These are scandalous, and the industry and we in the financial services industry in particular as gatekeepers need to address those. We need to address them right now at the bottom of the market cycle, because greed will prevent us from being able to do it at the top. Nobody will care. Rick,
I have thought about the word entrepreneur in the past, and what it means, and to try to step into the meaning of that philosophy. And I thought about the analogy that an entrepreneur might eat last, making sure that all of his people eat first. In the relationships that you've had over the years with the great entrepreneurs of the sector, the Ross Beatties, the Lucas Lundins, the Bob Quartermains, how would you define the entrepreneur? How does he eat in that sense?
Well, certainly the entrepreneur is driven. The great entrepreneurs eat fine anyway. But certainly in my experience, the great entrepreneurs have been much more focused on building value than making money. As a consequence of that, they've made a lot of money. There are people who go into an activity with the point of view that the activity will yield them a nicer house or a Lamborghini. Those aren't entrepreneurs, they're hustlers, and there's nothing wrong with a hustler. But a hustler isn't necessarily somebody who's going to make you money. Ross Beatty or a Lucas Lundin looks at a task, and it's the task itself, it's the project that is the motivation. That isn't to say that those people don't want to make money, but they make money by generating lots and lots and lots of utility. So I would say that the qualitative differentiation between an entrepreneur and some other primary economic actor would be that the entrepreneur sees a way to create value in society and just can't help him or herself. They have to attack that problem, and they see the solution to the problem, in every case that I've ever known, as being much more important than the timing or even the extent of the compensation that they get for solving the problem. The consequence of that is that more often than not, they manage to solve the problem, and by not worrying about making money, they make lots of money.
Rick, in winding down, is there anything you think we may have missed here?
No. The thing I want to come back to, though, again and again and again, for our clients and our listeners, is that markets work. The oil business demonstrated that really well. We had 4 years of extraordinary oil prices. We had 4 years of extraordinary margin. The consequence of that was that the incentive to innovate and produce more was very strong, and the capital was available to do it. At the same time, the utility of oil at 100, 105, 115 was low, and the consequence of that was that people began to do things like buy fuel-efficient cars or develop fabrication or manufacturing technologies that conserved energy. A situation where you have increasing supply and declining demand means ultimately they're going to have lower prices, and guess what? We had them. Now, people are looking for an excuse to justify low prices, and they're acting as though low prices are going to be here to stay. Equally silly. Low prices eliminate conservation. There's no particular incentive to save when you aren't saving much as a consequence of that effort. And there are much lower incentives to produce. Now, I'm not trying to say that this market will work immediately. The market can take a long time to work. We discussed in one of our prior interviews the idea of stranded capital, and the oil and gas business generated an awful lot of money in the last 10 years, particularly in the last 5 years. And the consequence of that is that they can cannibalize that capital. They can produce below the cost of production for a long time. But ultimately, the truth is that $60 a barrel is not a price at which the oil industry can earn its cost of capital. At the same time that prices will have to rise, prices will be able to rise because $60 is a price that generates spectacular utility. If you think about the energy available in oil and gas per unit of matter and the transportability of that form of energy, liquid hydrocarbons, they're extremely high. The utility that society gets from a $60 barrel of oil is extraordinary. If the price of something can rise and must rise, it will rise. I just can't tell you when. And of course, markets are very messy. This decline in oil prices has been inconvenient for some people, inconvenient for myself. That doesn't matter. Markets aren't organized around it, nor they should be organized around my convenience.
Yeah, I think you bring up a pretty good point there, Rick, because after seeing the sell-off in oil and the reducing cost of gas at the gas station, I feel like going for a joyride here up and down the coast of the here in San Diego, California. So thank you so much for sharing your comments with us. Pleasure to have you here again.
Always a pleasure, Takoa. Thank you.